So we're going to talk a little bit this morning about all this stuff that's been going on with GameStop, and then we saw going on with Silver, and then BlackBerry and AMC. What really is going on there? So we're going to try and explain that in a way that all of our listeners can sort of understand and appreciate just exactly what's going on there. Plus, we'll talk about the latest senior scams. It's rapidly becoming tax season, and that means, of course, that those scams, particularly targeting the elderly, are taking forefront once again. And so we want to share with you some of the ones that have been around for a while, and also some of the ones that sort of have some new twists, if you will, in them, particularly in light of COVID and the pandemics and getting your shot, if you will. So all kinds of stuff going on there in terms of schemes that target seniors. And then we'll talk a little bit about why it's so important to have dividend paying companies in your portfolio. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on News Radio WFLA Orlando Network, along with 96.9 The Game, home of the Buccaneers. It's a big day today, Sunday, Super Bowl Sunday. We're going to talk about that on the program as well. Our program, Dollars and Cents, also happens to be one of the top 25 financial planning podcasts on the entire World Wide Web. So that's pretty cool. Nearly 15,000 downloads of our program at last count. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready to help you change your life this very week by providing a successful and cost-effective retirement plan that produces superior results and provides you with peace of mind for the future. So Super Bowl Sunday, right? It's particularly significant here in Central Florida because, of course, the Tampa Bay Bucs, the home team, really it's just sort of about an hour away if you make the drive, because the stadium's on sort of the north side of Tampa, and so it's an easy one to get to. If you haven't been to a game yet, we would encourage you to do that because it's not that far away. But anyway, it's sort of our local, if you will, NFL team, and lo and behold, what's pretty unique is that Tom Brady's in the Super Bowl. No, that's not unique at all. He's in like the Super Bowl all the time. But what is unique about this Super Bowl is that it is the first time the host team is actually participating in the Super Bowl itself. So pretty unique all the way around. Of course, not that unique that Tom Brady's at quarterback, but very unique that the home team is actually, or the hosting team for the Super Bowl is actually in the game itself. So some pretty interesting stuff there. I'm sure all of our listeners over on 96.9 are super excited. We are taping the show, this morning's show, on Thursday of this past week because we are in sort of our own personal little Super Bowl. No, we'll not be on the field and we'll not be playing football, but running the Florida Marathon on Sunday morning. So obviously I can't do a radio program between 9 and 10 if I'm running a marathon. So we're taping this on Thursday. Hopefully things go well on Sunday. You'll hear about it next week in terms of how we did. Hopefully we make it. It'll be my third marathon in as many years, so excited about that. And hopefully the weather holds out. The weather looks like it might be rainy, so that might be a little bit of a problem as I'm navigating those causeways over there in Melbourne, because the race kind of goes through two different causeways twice. So it's like 4 different causeways up and down. Last one at like mile 25 and a half. So that's a tough way to end the race. But anyway, we're looking forward to it. Hopefully come in under 4.5, maybe 4:15 if things go well. I'm not sure the weather's going to help much on that. But anyway, so we have our own sort of personal little Super Bowl kind of thing going on as well. Culmination, if you will, of a season of training, much like it's the culmination of professional football season for the NFL with the Super Bowl. And of course, what we like to do each and every Sunday our program coincides with the Super Bowl, we always have to talk about the Super Bowl indicator. And what's neat about talking about the Super Bowl indicator this year on the program is we're actually on a sports channel. So that kind of really melds well, if you will. This is for not just our listeners, but specifically our listeners on 96.9 The Game. I'm sure everybody there, the regular folks over on that network, are getting very excited, very geared up for the football game, the Super Bowl, later on today. So what's the Super Bowl indicator that we like to talk about each and every year? Well, it's sort of a superstition or a market indicator, if you will, that was created back in the 1970s. And what it was it said that whoever wins the Super Bowl, whether they come from whichever league they come from, that's going to determine exactly what the market is going to do. So as you might well imagine, much like our fearless forecast that we do at the beginning of the year, along with any other market indicators, it's cloudy at best in terms of its accuracy, right? Because you can't really predict the future. So it's all kind of fun and games and something that we like to talk about from time to time, particularly, of course, on Super Bowl Sunday. But at the end of the day, it's really not a way to ultimately address the allocation of your portfolio. We're going to talk more about that when we start talking about dividend-paying stocks later in the program. But the Super Bowl indicator was sort of discovered, if you will, by a guy by the name of Leonard Koppett in the 1970s, where at that point it had not failed. And so what it says is that if a team from the AFC wins, the markets will be down. But yet, if a team from the NFC or a team in the NFL prior to the NFL-AFL merger wins, then the markets will go up. So if AFC wins, markets down. NFC wins, markets are up. So fast forward. So at the time that this Leonard Koppett discovered this, or suggested this Super Bowl market indicator, there had only been a few Super Bowls, and at that point it had been right every single time, but there had only been 6 Super Bowls. Fast forward, like 53 years and counting, and the success rate is about 75%. It has been wrong 5 years in a row now. So the old Super Bowl indicator may not be something that we're starting to bring up on a regular basis on the program, because it's pretty inaccurate. So the reality is that here's how it works. If a team from the AFC wins, then the markets go down. If the team from the NFC wins, then the markets go up. So its accuracy has been a little bit suspect of late, but who knows? We'll see how it all plays out. It's probably got the reliability of Punxsutawney Phil, right? He said 6 more weeks of winter. The reality is that Groundhog this past week, also one of those indicators that doesn't necessarily. But anyway, if you want to give yourself another reason to root for the Bucs and Tom Brady, it's the stock market indicator. If the NFC wins, it means the markets are going up. Let's hope that it actually gets back on track after 5 off years in a row. With that, we'll wrap it up and take a break, and then return with a conversation about GameStop and what's going on there. All that and more on Dollars and Cents. So what's all this conversation about GameStop anyway? It's really been dominating the headlines over the course of the past couple of weeks, and you hear GameStop being talked about predominantly, but then you also heard this past week about silver being talked about, and also a company like BlackBerry, AMC, those types of companies. And so we wanted to spend some time in this segment really sort of explaining a little bit about what's going on, because what's happening there is a story old as time. It's a story of pride and greed. So let's begin. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective retirement plan that produces superior investment results along with peace of mind for the future. So the story of GameStop and its 400% rise in the prior week sort of starts with pride. This past week, so the prior week, GameStop up like 400%. This past week, it was in a more of a period of decline. Again, we're taping the show on Thursday, so who knows how the week actually really fully plays out. But the first 3 days of the week was generally on the decline for GameStop. And so the story really starts with pride. And pride is the way that these hedge fund guys sort of operate, right? When they brag and preen in front of the cameras on CNBC on a daily basis, that builds their personality. That is pride coming out at its purest human emotion. When you go on a major network and say, we're doing this, we're shorting GameStop because we think it's the blockbuster of the past, and the value of that company is going to go to zero, and we're just going to make tons and tons and tons of money. So you have folks like Andrew Left of Citron Capital, you have folks like Gabe Plotkin of Melvin Capital that love the attention, love the aura, love that comes with being a hedge fund manager, and in the case of Plotkin, he was even able to like leverage it into a friendship with Michael Jordan to become part owner in the Hornets and stuff like that. So anyway, that's pride. So all these guys, these hedge fund guys, started bragging up how they had shorted about GameStop. So let's stop right there and let's talk a little bit about what it means to short something, because particularly short a stock. And it's a means of basically positioning yourself in such a way that you think the price, or positioning your investments in such a way that if you believe the price of a particular stock is going to go down, then you buy an option to sell that stock at its current price. But because it's an option, then you don't actually own the stock itself. So if you have an option to sell the stock at its current price, your expectation is, well, okay, when I have to ultimately honor this contractual obligation in the form of this option, I'm going to be able to go in the market and buy it for less of a cost than what the option obligates me to do, right? So if I've got an option to sell the stock at a current price, let's say it's $20, and I think the price is going to go to 10, well, then I'm going to make a lot of money, because I can then honor the contractual obligation of that option, because after all, that's what an option is. I can then honor that contractual obligation by simply buying it at 10 and then reselling it at 20. I mean, I'm going to make 100% profit on that if that actually plays out. So that's sort of what the folks were doing, or the hedge fund guys were doing, when it comes to how they were shorting the stock. So they were using options to be able to do that. The problem is, if the price goes up, you are forced to buy that stock at whatever that price is when it comes time for that option to be fulfilled. So in essence, you can lose pretty big. Not only can you lose pretty big, way beyond what you actually invested. Because remember, when you buy an option, you spend just a few dollars to buy the right. You don't actually buy the stock. So when you buy the option, you spend a few dollars. So you can pour a whole lot of dollars into options, and if that goes the wrong way, then you've got to fulfill that using 10x or 20x the amount of money that you put into those options in order to make those contracts whole. So if the price jumps up pretty dramatically, what happens is a squeeze, right? And that's why it's called a short squeeze. Because so if you shorted the stock, you think you're going to be able to buy it later on for less, and the price goes up, then you get squeezed pretty rapidly, because to buy the options, you only had to spend a little bit of money. Now to buy the stock, you got to spend a whole lot more money. So there is our prideful antagonist, if you will. Enter now into the story our protagonist. We've got the prideful antagonist going on media bragging and telling exactly what we're going to do, and here we're going to make so much money, and here's how it's going to play out. And now comes our protagonist. And the neat thing about the story is the protagonist is just normal people like you and me that were like listening to this stuff and saying, wait a minute, something sounds kind of funny here, because if there's that much short activity on this particular company, if I get sort of a group of people to believe that it might go the other way, not only might we be able to push it the other way, but that having the stock price goes up may in fact wind up dramatically accelerating. So here's where they all sort of band together. They use social media platforms like Reddit, which is basically sort of an aggregator, a good place for chat rooms. Specifically, Wall Street Bets has sort of been the one that folks have been focusing on. And they figured out that if the hedge fund guys were bragging about their shorts, then enough of them, if they took sort of the opposite view, well, then they could probably drive things the other way pretty dramatically. So this is where we like to refresh people's memory. Look, every trade in Wall Street has two parties, and those two parties sort of believe exactly the opposite of each other. So our protagonist, if you will, in this story winds up being normal folks who successfully banded together and ultimately helped to drive the price of GameStop up. When the price started moving up, all of these hedge funds that had these options outstanding said, oh, wait a minute, we got to start buying these shares, otherwise we're going to lose our shirts. And so that produced a lot more buying pressure in the market, not much selling pressure. And so fundamental economics, if you've got a lot of buying pressure, the price goes up, and goes up pretty dramatically. So that's what happened. Here's the thing. That could really only happen like with a company of GameStop size. And by that I mean GameStop, for example, 70 million shares outstanding. If you contrast that with Microsoft has 7.5 billion shares outstanding. So it's a big difference in terms of size. So it has to be a smaller company in order for to sort of see this play out. 7.5 billion shares on Microsoft, you couldn't get enough people to sort of band together to be able to kind of drive the markets the way that it does. And then of course you need the ability to be able to communicate with a lot of people and get them all pushing in or in the right direction. And that is where the power of social media comes in. The other thing is, it's sort of tricky to sort of pin that as an illegal activity, because you really need sort of some real collusion on it. Just a bunch of folks working on social media that says, hey, let's buy this stock, let's buy this stock, buy this stock. That doesn't necessarily rise to the level of anything illegal that these folks have done. Now, obviously, the SEC is going to investigate that. We'll see whether there was somebody sort of behind the scenes, if you will, that was making things as dramatic as they were. But ultimately, remember, we said this story was a story of pride and greed. So to our happy protagonists, don't get greedy. If you've made a ton of money, congratulations, you won that round, go for it, that's great. Sell, don't get greedy. Pay off those student loans, pay off those credit cards, maybe even pay off the mortgage if you were really successful on it. But do not stick around to see how this goes, because just like the tulip bulb mania in the Netherlands in the 1500s, it does not end well. It is not sustainable. So be careful. Don't get greedy. Get out, enjoy the profit, and enjoy the story. A story old as time, pride and greed, if you will. With that, we'll take a break and return here on Dollars and Cents. So why are dividend-paying companies such an important part of one's portfolio, especially in retirement? Well, we're going to give you 4 distinct reasons why you want to make sure that dividend-paying companies or dividend-paying oriented funds are a part of your mix, particularly in order to generate out income in retirement. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on News Radio WFA Orlando, along with 96.9 The Game, home of the Bucs as well. So look forward to seeing them play in the Super Bowl. We're also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on our various podcast platforms, whether that's iTunes, Spotify, Amazon Music, whatever the case may be. we are there. If you want to see a video of our program as well, that's available over on our YouTube channel at Nelson Financial Planning. So all sorts of ways in which you can connect with us during the course of the week. So make sure you subscribe to us on your favorite social media platform. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that provides peace of mind and produces superior investment results. So before we begin on sort of those reasons for why you want to own a dividend paying company, let's first of all start first with sort of setting the table of exactly what a dividend paying company is. And a dividend paying company typically is one that sort of has a stable business model, if you will, where the revenue that it's bringing in on a very regular basis is more than its normal expenses in any given quarter or year. And so what happens anytime, right, you have revenue as a business more than your expenses, you have a profit. And so what the company does is a lot of companies will take that profit and sort of reinvest it in themselves. Maybe they'll build a new manufacturing plant, or they'll invest in some new technology, or whatever the case may be. But a dividend paying company is traditionally one that's sort of been around for a while, and it's got a relatively stable model. So instead of doing that, what they do is they take a portion of that profit and pay it out proportionately to all of its shareholders. That's the concept of paying a dividend, where basically as a shareholder, you're getting a portion of that company's profit on a regular and ongoing basis. Most companies these days pay dividends on a quarterly basis. Sometimes they'll pay them annually, but most of them that are regular dividend paying companies will pay them on a quarterly basis. So that's sort of the concept of the notion of a dividend paying company. It's a portion of the profit. The portion of that profit that's paid out to the shareholders on a proportionate basis, meaning the guy that owns 100 shares gets less than the guy that owns 1,000 shares. That portion that's paid out is, of course, referred to as the dividend. So that leads us sort of to the first reason, if you will, to own dividend paying companies or funds that are highly oriented to those dividend paying companies, is that it does provide a relatively stable income source as a portion of your portfolio. Because again, if I am a dividend paying company, that's not something that, oh, hey, this quarter I think we'll pay a dividend, next quarter we don't. No, shareholders don't appreciate that inconsistency in terms of the payment of the dividend. So what happens is that if you are a company that starts to declare a dividend, the expectation is that that dividend is going to be done on a regular basis. So that leads to a certain sort of steadiness, if you will, of the income that you get from dividends. Because typically, what's interesting right now about dividends and dividend yields is that a dividend will pay out because it's part of the profit. It pays out regardless of what the share price of that particular company is. So it's irrespective of whether the share price is $10 or $12. If they're paying a 12-cent per share dividend, then you're still going to get that 12 cents per share of a dividend. Typical dividend yield on those types of companies, if you kind of sort of look at, you can certainly look at it at individual companies, and there you'll see all ranges of current dividend yields. But if you look at sort of a basket of dividend paying companies today, what you'll find, there's some mutual funds out there, a lot of mutual funds out there that sort of focus on dividend paying companies. What you'll find is the yield on them is somewhere between 1.5% to 2% today. So 1.5% to 2% may not sound like a big number until, of course, you start to sort of do the comparison of what other things are paying, right? U.S. government bond yields today at about 1%. Savings accounts at 0, basically. So the attractiveness of a dividend yield at 1.5%, 2%, stable source of income in retirement, that's one of the first reasons why they are as important to your overall portfolio. The other thing, the next reason why you want to certainly make sure that they are a portion of that picture in retirement is that dividend payout, that dividend yield, if you will, adds to the overall return, which then allows you to keep up better with inflation. Dividend paying companies usually pay those dividends, not just only do they pay them consistently, but year after year, there's a tendency for those dividends to gradually increase as well. If you think companies like Coca-Cola, Pepsi, Johnson & Johnson, Colgate, 3M, Walmart, those types of companies, they actually have a history of not just paying dividends, but of increasing those dividends over time. So that dividend allows you another source of income increase that allows you to stay ahead of inflation on a regular basis. So that dividend yield also contributes a lot towards being able to stay ahead of inflation, which from a retirement perspective is incredibly important because the cost of goods is going to go up over the course of your retirement, particularly healthcare. And so at the end of the day, you want to have the ability to certainly stay ahead of inflation, and certainly the dividend allows you to be able to do that. Here's sort of one of the really neat things about dividends is that dividends, in fact, are taxed at a lower rate than interest. So go back to sort of those numbers we were talking about in terms of current dividend yield on a basket of dividend paying companies, typically about 1.5–2%. U.S. government bonds at 1%. The reality is that there's also a significant tax difference in how those dividends that you would get from those companies fare on your tax return versus the interest that you would get on that government bond. The interest that you get from a bond is taxed as ordinary income. So what that means is that whatever your marginal tax rate is, that's how much you're going to pay. Marginal tax rates today, go up to like 35–37%. So that's a pretty significant amount of income that you would wind up having to pay, or a pretty significant slice of that interest that you've earned that you then have to turn around and send off to the IRS. Meanwhile, on a qualified dividend, the maximum rate that you will ever pay on that is 20%. Most of the time, you're paying 15%. So that's like half the effective tax rate, which again further boosts that benefit of that dividend yield, because on an after-tax basis, you're well in front of what you would be getting on a comparative interest payment as well. And then lastly, dividend paying companies have a history of sort of holding up better in tougher economic times. Again, dividend paying company generally is going to have a stable business model. So stable business model means that they're generally going to be able to hold up in a tougher economic time. So people are still going to drink Coke, people are still going to use baby shampoo, still going to go to Walmart, things like that. Those types of companies really do have a tendency of hanging or holding up very well during tougher economic times. So those are the 4 reasons why it's important to have dividends as part of your portfolio, particularly in retirement. Steady income source, allows you to stay ahead of inflation, tax at a much better rate, and then they hold up better in tougher economic times. So make sure you got part of that as part of your portfolio. You have to look at the underlying allocation of your portfolio. It's not enough to just look at the funds and whatnot. You've got to drill down. You've got to take a look at exactly what companies you own in your portfolio in order to make sure that you're not gotten overweight on the growth side. That's really a concern that we have for a lot of investors today. A lot of these tech companies have really driven the market and driven the allocation share of people's portfolio. So be careful of that. So make sure you check that out on your investments as well. With that, we'll take a break and continue the conversation here on Dollars and Cents. So tax season is rapidly approaching, even though the IRS isn't taking returns until February the 12th. We talked about that last week on the program, just how far they are running behind. But the start of tax season also means that there is an uptick in the amount of scams, particularly the scams that target seniors, because as you are in the midst of tax season, you start to think more about your finances, IRS, and so ultimately the scammers know that, and so they specifically target this particular time of year. They pretty much these days target all 12 months of the year, but there's definitely an uptick during the course of tax season, especially with COVID and the pandemic and the lockdowns. really making people more lonely and isolated than perhaps ever before. So we're going to talk about some of the scams that are typically out there and ways that you can avoid them on this segment of the program. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the entire World Wide Web. So make sure you check us out on our social media and podcast channels of your choice. Have any problems finding us on any of those channels, just go to our website, nelsonfinancialplanning.com. Upper right hand corner, click on the icon that looks most familiar to you, and you'll get directly connected to our channel. So my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that provides superior investment results and peace of mind for the future. So with those scams becoming more and more common, I mean, the numbers are just staggering. Over the past 5 years, the number of scams and cybercrime versus the elderly has gone up by 400%. I mean, just huge increases over the course of the past few years. As you have more and more seniors getting online, really in a lot of cases for the first time as a result of the pandemic, and sort of being forced to buy stuff online or order your groceries online that you might not otherwise have done, there's a lot more potential targets. It's estimated that about 650 million in online fraud occurred in 2018. I haven't seen those numbers for 2020, but I can only imagine they were significantly greater. So what are some of the scams to watch out for, and how in fact can you avoid them? So we've got 5 different sort of most popular scams, if you will, out there, along with some advice on how to avoid them. First one is one that's been around for a long time, and as we said, during tax season, you find that it increases itself with its frequency, and that is the IRS calling you out of the blue. Here's the reality. The Internal Revenue Service is never going to call you out of the blue asking you to send money. Otherwise, if you don't send money, you're going to jail. That does not happen. They don't do that. If you get that call, you need to just hang up. Nothing more you can do about it. Just hang up. At tax season, this one becomes very popular, and scammers are relatively successful on it. That's why you keep hearing about it, and why it keeps sticking around is because there's still some success rate at it, because the reality is when someone hears that it's the IRS, they get their attention, and it creates a lot of fear, and the scammers on the other end of the line are pretty good at stoking that fear and really getting you to do something that you might otherwise not do. So to avoid it, if the IRS calls and says you owe us money, click hang up, and hang up immediately. The other thing that scammers like to do is they like to sort of play on the current headlines, right? So obviously with COVID and the pandemic, not only are they taking advantage of the fact that a lot more people are lonely and isolated out there, but they're also finding a new opening representing like the CDC or the World Health Organization, or professing that they've got vaccines and all you need to do is sign up. The answer is to really avoid those emails with those attachments that are sort of fake, if you will, is to make sure that you install and keep up to date the latest antivirus software on your computer. That's a good way to sort of screen out those emails that are from folks that want to put malware or put software on that's going to ultimately require you to pay a ransom. There's a lot of nefarious things that can happen that can cause you to lose your data and lose your money. So be careful when you're opening up any emails or attachments or anything like that. Make sure that they are who they represent. The key sort of red light, if you will, that should go off in your head as you're reading it is typically it doesn't quite read that accurately, or there's misspellings or mispunctuations. That's sort of the giveaway, if you will, that hey, this is not from folks that they say they are. really the reality is to try and reduce that or avoid that. Just make sure that you are keeping the antivirus software on your computer as up to date as it possibly can. Another one, and this one is kind of, I guess, newer a little bit. With the increasing cost of healthcare, folks are actually using people's identity to actually get medical treatments done. So make sure that you're reviewing your health statements pretty thoroughly, because healthcare obviously expensive, and so you're seeing people pose as others in order to kind of get medical treatment or prescriptions as well. So make sure, in order to avoid that, you've got to review your medical bills pretty carefully. And so when you get those explanation of benefit letters in the mail, and I understand you look at them, you're like, well, what does all this mean? It says it's not a bill, so I'm not going to pay attention to it. But what's really happening there is it's detailing exactly what the medical service was that you had done. And if you look at it and you're like, well, wait a minute, I didn't have an appendectomy. I'm pretty sure I didn't. And so that would then tell you, hey, there's an issue with identity and use of your health insurance and your medical information. So make sure you really look at those explanation of benefits statements, because those will tell you what services you got. And if it's a service that you didn't actually get, then you need to start calling your health insurance company and investigate further. The last one sort of is the one that says, if your grandchild calls asking for money over the phone, sorry, grandkids, but your grandparents should be hanging up. Actually, I had a friend's parents that fell victim to this one. And it's funny how it works, because, right, if you call and you're muffled and you can't hear and you say, Grandma, what's the person's natural instinct? It's to say the grandkid's name. Grandma, Grandma. Oh, Johnny, is that you? Oh, well, guess what happened? You just told the people on the other end of the line what the name of your grandkid was. Now they've got a little bit more personal information. Now they can kind of reel you in a little bit more. So to avoid that, resist the urge, even if it is supposedly your grandson, hang up and then call them on their number that you know is their number, and just check in on them that way. That's a great way to do that. Lastly, tech support is not going to reach out to you randomly and say, hey, we're here to help. Tech support's pretty busy right now with the pandemic, and so they're not going to just randomly reach out to you. So let's face it, there's a whole generation of people that are getting online and are new to getting online, particularly as a result of the pandemic. So be very, very careful of those types of phone calls. And lastly, be careful of making friends on the internet. Just like as you would tell your kids not to make friends randomly with strangers in the park, don't do that on the internet anyway. Just because someone is your friend on Facebook isn't actually your friend. There's a lot of people out there posing as friends that really aren't. So make sure you're careful with that as well. Same thing you would tell your child in a park, you need to tell yourself as it relates to that, because what happens is they send pictures, they send attachments, they send emails, and then you wind up getting malware, ransomware on your computer. Anyway, some things to watch out for, particularly this time of year. With that, we'll wrap it on up. Have a great rest of the Sunday. Go Bucs!